Buddy, good to have you with us. Welcome to Morning Live.
Hi, Sakina. Thanks so much for having me again.
So first off, your view on the speculation that South Africa might be hit with yet another interest rate increase. What's your take on that and the implications that this would have on households and the economy at large?
I think that what we really need to do is identify the main drivers of inflation at the moment, and the drivers of inflation in South Africa is not that South Africans have got too much money in their bank accounts generally. The broad private sector of South Africa is at the moment is rand starved, and we don't have our businesses are struggling. There's not enough people to buy that have enough money to buy our products. Households can't afford at the moment to buy stuff. There's so much unemployment, and the drivers of inflation are things that are happening overseas at the moment. So there's supply and demand issues happening in the international markets. We have open markets, so our food and our produce is being sold overseas, and the South African Reserve Bank at the moment is trying to control South African inflation, which has been driven by overseas factors, and it's not going to help to raise interest rates and take more money out of South African bank accounts. All that's going to do is add to the costs that are driving inflation at the moment. Because at the moment in South Africa, our inflation is cost pushed. It's not demand driven. It's not demand driven means that everyone's got so much money that we're just bidding up the prices of stuff, and that's driving up the price of goods. And that's not what's happening in South Africa at the moment. What's happening in South Africa at the moment is that these international factors are driving up the cost of product in South Africa because the cost of production is going up. We've got fuel price increases. It's got nothing to do with South Africans. We've got electricity price increases, which are driven by amongst other things, one of the biggest costs in South Africa for Eskom is the price of its debt. It's paying a lot of interest on its debt, and that's driving up the price, the electricity tariff. And if we can reduce the costs that are driving up the prices of South African fuel and electricity, those things will have knock-on effects on our ability to produce stuff cheaper and keep more rands in the pockets of our households and businesses. And that's what we need right now. We need to have more employment. We need to have more demand from consumers in South Africa, and our producers need to have lower costs so that we can produce more. And more cheaply, and we can compete with producers overseas. And what's happening at the moment is that the South African Reserve Bank is trying to control this cost push inflation by reducing South African consumers' ability to bid on our produce against overseas consumers. And so we're having less and less South Africans can actually buy stuff. We're having less employment. Our stuff is being sold overseas. Overseas bidders are bidding up South African food prices and stuff like that, and we are not actually bidding it up ourselves. And the South African Reserve Bank is reducing our consumers' competitiveness, and at the same time reducing our producers' competitiveness by increasing interest rates. So the cost of business is going up. They're increasing it, the cost of business. And it's just a kind of a crazy thing to do, because what you end up having is less supply of goods, because businesses are going bust, and you have less employment, and the households have less money, so it's a crazy situation. We have almost like 50% unemployment in South Africa, and I really don't think that anywhere else in the world that would be allowed. It's just kind of seen as normal in South Africa, and I think that's a very strange state of affairs. I think that any other central bank in the world would be under immense pressure to reduce unemployment and to reduce the cost of business.
So looking at that and what you've just explained to us, Buddy, and some economists have contended, like as you've said, that the Reserve Bank is not fully using the monetary policy framework at its disposal, but just mainly utilizing the interest rates, which might as well be referred to as interest rate policy than monetary policy. What are your views on this? Because why is the Reserve Bank then not looking at other things to do in order to assist the consumers as well?
Yeah, I mean, what we really should be doing as a nation is looking at what needs to be increased in production. So we need to. So at the moment, we need more electricity supply. We could be investing in food production. We could be investing in green energy and electronic vehicles. We could be all the things that we need at the moment is what the South African Reserve Bank should be directing money at very low interest. And instead of doing that, what they're doing is they're raising interest rates, pretending that they're not the monopoly issuer of money into the economy, and pretending that we rely on money from overseas. And the reality is that the money that's been created by foreign banks, dollars, pounds, yen, and all those kind of foreign currencies, cannot be spent in South Africa. There's no reason why we need to borrow dollars in order to invest rands into the South African economy. The South African Reserve Bank is the monopoly issuer of rands, and they should be directing the banks, the commercial banks, to be lending money at our productive businesses at as low interest as possible, and also at government. So government could be investing money into electricity supply, into employing people. There are many things that we need. We need more policemen. The costs of crime at the moment is immense. We've got, we need more healthcare. We need more teachers. We need to build schools, universities, all that kind of stuff. The government could be doing that, and the South African Reserve Bank could be lending money at much lower interest rates than what they're pretending that we need. That the currency issuer, which is the state, needs to borrow money from private sector middlemen, which at the moment 45% of bond sales are to the financial sector, and 30% are to the foreign sector. So we effectively the government is borrowing the rands that it issues back from these private sector middlemen. And what that effectively does is transfers hundreds of billions of rands every year to the financial sector and to the foreign sector, which is actually inflationary. And it's adding to the costs of business. The electricity prices are so high, the fuel prices. There's the fuel levy, for instance, is kind of a crazy thing, because a lot of government spending is going towards paying these interest rates, high interest that it doesn't need to. And we could be reducing the amount of money that government spends on interest, and directing more of government spend towards productive investment, and productive employment. And that would mean that more of the money that government spends is productively invested, and less is going towards this non-productive interest payments, which is going mainly to the financial sector and the foreign sector. And if you look at what's happening in the South African economy, you see the financial sector is just growing incredibly huge. It's massive at the moment, so 25% of GDP at the moment. It's much, everyone's talking about the size of government, but what's really the problem at the moment is the size of the financial sector. And we need to start directing money towards our productive sector. And what our policies at the moment are basically directing money at the financial sector and at the foreign sector. And we need to actually start understanding where the money is coming from. It's coming from the South African Reserve Bank, and the South African Reserve Bank regulates the financial sector. And at the moment, what they're doing is they're just benefiting them. And I really think we need to look at and why they're doing that, and possibly look at the link between Treasury and the South African Reserve Bank and these financial sector companies. These are the executives in in these institutions tend to have, there's like a revolving door between these big banks and that's, it's a bit worrying, you know, that I just wonder who's standing up for our productive industries and our households, because yeah, it's, you know, these costs just adding up.
Yeah.
And it doesn't make any sense.
And for us as taxpayers, because as you say, it beggars belief why government would insist on, you know, going a route that would cost the taxpayer more in the end, in terms of paying back interest, you know, at a much higher rate, and why they wouldn't use what is obviously readily available at the Reserve Bank. But as you say, we need to look at that relationship, that revolving door between these institutions and what is really going on there. But just coming back to the Reserve Bank, Buddy, in terms of what other tools can they use in order to moderate the rise in prices within the monetary policy framework? What can they do?
Well, definitely, you know, if you look at the electricity prices, a large part of Eskom's costs are going towards the interest payments. So they can, South African Reserve Bank can do a lot to reduce those interest payments. You know, they can restructure the debt, and the fuel prices at the moment. So much of government's of the fuel prices, I think it's 35% is going towards tax, and we have to ask ourselves, why is the rand issuing state extracting rands from, you know, the productive sector and our households with the fuel levy, when our businesses and the privates, the whole private sector generally is rand starved, and these fuel levies are driving up the cost of business, cost of production, and they're driving down demand because you're extracting money from the private sector, and you're wondering, well, why is the state doing that when they have a limitless amount of rands available, and demand is too low, and the costs are driving inflation. What we could be doing at the moment is we could be injecting money into the system through productive investment on things that are going to reduce the costs of our private sector, you know, and increase the supply of the things that we need, like electricity and all those kind of stuff. And in doing that, we would, you know, if more money, if more of the money that governments spent on this kind of investment was coming at low interest from the South African Reserve Bank instead of from taxes, instead of from high cost loans from the private sector middlemen, then we would actually be driving down the cost of you know, the expenses that are driving inflation at the moment. And as long as we have cost push inflation and demand is too low, that would make sense. Obviously, if our economy is overheating and you know, we've got full employment and inflation being driven by the fact that South Africans have got too much money in their pockets, then it makes sense to extract money from the system with taxes and maybe with higher interest rates. But at the moment, that's not what's happening. We've got mass unemployment, and the risks involved with the mass unemployment and poverty that we have at the moment are much higher than, you know, the risks involved with directing money at as low cost as possible at productive employment and the things that we need. It's almost like we're sabotaging ourselves. You know, no one in the private sector would ever go to a bank and you know, if you offered a loan at repo rate, and then the bank offered you a loan at 10%, you would never take the 10% loan, you would take the repo rate loan. And what's happening at the moment is government is actually choosing to pay high interest to these private sector middlemen for the rands that it issues. And it's insane. It just obviously doesn't make any sense at all. But you know, that's what's happening.
Indeed. And Buddy, thanks so much for speaking to us this morning, and definitely something that I think we need to interrogate further. Buddy Wells is a public finance activist discussing the potential of another interest rate hike and its implications on South Africa's economy and households.